Now that we know the mechanics of multivariate regressions, we can add other known risk factors to our model to help describe returns and calculate expected returns, and to what we can attribute variations in return, risk, and other factors. So here's the idea. We have a set of factors that we might be able to use. We know the market is a priced factor. We also know that the Fama-French factors, equity style, large cap, mid cap, small cap, growth, blend, sometimes blend is called core value. We can also add financial factors or other economic trends. So we can add East Asian industrial growth, or we can add the euro versus the dollar, or we can add interest rates. We can add a commodity, so energy, corn, or copper. If a commodity is an input or an output for the company, if it's an input, then an increase in the price of the commodity is going to hurt the company, and we would expect a negative beta. But if it is an output, then we would expect an increase in price to benefit the company. We would expect a positive beta. And so here's two models that we can look at. We have oil or coffee or euros or copper. We can look at the return of a stock. It's alpha, it's beta relative to the market, it's beta relative to the small stock premium, it's beta relative to the value stock premium, and to this we can add oil, for example, or we can add coffee, for example. As a proxy for the return on oil that affects the specific company that we're interested in, we will use the percent change or the return to the rolling near month or front month futures contract for oil and for coffee. And the reason is that physical commodity markets can be segmented. It can be difficult to get prices for a specific type of oil or type of coffee, but market participation in these futures markets is very high, so these contracts are very liquid. They reflect current prices. And even if this is not the specific type of oil that the company that we're examining uses, or in fact, we're going to see that we're going to be looking at companies that are really buying and selling jet fuel for one of them, but the change in the price of oil on the futures contract is going to be extremely similar to the change in the price of jet fuel, and so we can use the returns. The same thing for coffee. The particular type of coffee or market of coffee that that Starbucks, which is what we're going to be looking at, is using. I don't really know what that's going to be, but I know that the percent change in the price of coffee that they're paying is going to be very, very similar to the percent change in the coffee futures contract, and so that's what we'll use. So let's go to a couple of spreadsheets, see how these regressions look, and see if we can interpret the results.